What happens to my investments? History shows that wars do not only reshape countries, they reshape entire financial markets. When conflicts begin, capital moves extremely quickly. Some assets collapse, some surge dramatically, and some countries suddenly become safe financial shelters where global wealth flows during times of uncertainty. Right now, geopolitical tensions in the Middle East have once again reminded investors of this reality. Rising friction between the United States, Israel, and Iran has increased volatility in energy markets and pushed investors to reconsider where their money is safest. Whenever tensions rise in regions responsible for global energy supply, financial markets immediately react. Oil prices surge, currencies fluctuate, investors begin shifting their portfolios. And this raises an important question. Where does smart money go during war? Today, we will break this down step by step. First, we will look at how wars historically affect financial markets. Second, we will examine which assets tend to rise during global conflict. Third, we will explore how three key regions, the United States, Dubai in the Middle East, and Singapore, behave during periods of geopolitical instability. And finally, we will discuss what these patterns mean for modern investors today. Let's begin. Part 1. How wars shock financial markets. When war breaks out, financial markets respond almost immediately. Investors fear uncertainty more than anything else, and war is one of the most unpredictable forces in the global economy. The first reaction is often a sharp drop in stock markets. Companies depend on stable supply chains, predictable costs, and functioning global trade routes. War threatens all of these at once. Factories may lose access to raw materials. Transportation costs increase. Governments may impose sanctions or trade restrictions. Because of these risks, investors often rush to sell stocks during the early stages of conflict. But interestingly, the initial crash does not always last. Historical market data shows that many wars cause short-term shocks rather than permanent market collapse. Once investors begin understanding the scope of the conflict, markets gradually stabilize. This pattern has repeated itself many times. During major conflicts in the past century, stock markets often dropped sharply at the beginning of war but recovered within months as investors adjusted to the new economic reality. However, while stock markets may eventually recover, other parts of the global financial system react very differently. One of the most immediate effects of war is a surge in energy prices. This happens because many geopolitical conflicts occur in regions that produce critical resources, such as oil and natural gas. The Middle East, for example, remains one of the most important energy regions in the world. A large portion of global oil supply travels through a narrow waterway known as the Strait of Hormuz. This shipping route connects oil producers in the Persian Gulf with global markets. If military conflict threatens that route, energy markets immediately react. Oil prices spike, shipping insurance costs rise, and energy-dependent economies begin preparing for inflation. This is why tensions involving Iran, Israel, or Gulf states often trigger volatility in global commodity markets. Even the possibility of disruption can push oil prices upward, affecting industries around the world. Energy is the foundation of modern economies. When oil becomes expensive, everything becomes more expensive. Transportation costs rise, food prices increase, manufacturing becomes more costly, electricity becomes more expensive, and inflation spreads throughout the economy. This is one of the key economic consequences of war. But there is another financial reaction that happens almost simultaneously. Investors begin searching for safety. Part 2. The flight towards safe haven assets. When geopolitical instability rises, investors begin moving money into what are known as safe haven assets. These are investments that historically maintain value during periods of crisis. The most famous safe haven asset in human history is gold. For thousands of years, gold has served as a universal store of wealth. Unlike stocks or currencies, gold does not depend on the financial health of any single government or company. Gold cannot go bankrupt, it cannot default, and it cannot be printed by central banks. Because of these characteristics, gold has historically performed well during times of geopolitical tension. Whenever war breaks out, many investors move part of their wealth into gold as a form of financial insurance. Gold prices have often surged during major crises because investors trust its long-term stability. But gold is not the only safe haven asset. Government bonds from stable countries are another. When investors become nervous, they often purchase sovereign debt issued by strong economies. U.S. Treasury bonds are one example. Because the United States has the world's largest economy and deepest financial markets, many investors consider its government debt to be relatively secure. During periods of global instability, large amounts of capital flow into these bonds. This demand pushes bond prices up and lowers their yields. Currencies also behave differently during crises. Some currencies weaken because investors fear economic instability. Others strengthen because global investors trust the issuing country's financial system. Historically, currencies such as the US dollar and Swiss franc have often strengthened during periods of geopolitical stress. But safe haven assets are only part of the story, because while many industries suffer during war, some sectors actually benefit from it. Part 3. Industries that rise during conflict. War changes economic priorities. Governments suddenly shift spending toward defense, energy security, and supply chain protection. This creates opportunities for certain industries. The most obvious sector is energy. If conflict threatens global oil supply, energy prices rise. This benefits companies involved in oil exploration, production, and distribution. Energy companies may see increased profits because the value of the resources they produce suddenly becomes higher. The second sector that often benefits from war is the defense industry. Military spending increases dramatically during periods of geopolitical tension. Governments purchase aircraft, surveillance technology, cybersecurity systems, and advanced weapons. Defense contractors that supply these systems may see their revenues increase as military budgets expand. The third sector that sometimes benefits is commodities. Global supply chains are disrupted, which can push up prices for materials such as metals, agricultural products, and industrial resources. When supply becomes uncertain, prices tend to rise. Commodity producers may therefore benefit during certain conflicts. However, while these sectors may perform well, many others suffer. Tourism often declines during periods of instability. Airlines may face reduced travel demand. Global trade may slow as shipping routes become riskier. Financial markets therefore experience both winners and losers during wartime conditions. But perhaps the most important financial shift during war is not about industries, it is about geography. Part 4. How capital moves across the world during war. When uncertainty rises, investors start asking a very simple question. Where is the safest place to keep my wealth? Money moves very quickly during crises. Large financial institutions, sovereign wealth funds, and wealthy individuals may shift billions of dollars across borders in search of stability. This process is known as capital migration. Historically, capital tends to flow toward countries with several characteristics. First, political stability. Investors prefer countries with stable governments and predictable legal systems. Second, strong financial institutions. Countries with large banks, advanced financial markets, and reliable regulations often attract global capital during uncertain times. Third, neutrality in geopolitical conflicts. Nations that maintain balanced diplomatic relationships may be seen as safer places to hold wealth. This is why certain financial hubs become extremely important during global crises. Cities like New York, London, Singapore, and Dubai often attract international capital during periods of instability. These locations serve as gateways between global markets. They offer strong legal systems, developed banking infrastructure, and access to international investment opportunities. When global tensions rise, investors often move money into these financial hubs. But each of these locations plays a different role in the global economy. To understand how capital flows during conflict, we need to examine them individually. Part 5. The United States during global conflict. The United States remains the largest financial system in the world. Its stock markets represent a significant share of global investment capital. Because of this, global investors cannot easily ignore the United States even during periods of geopolitical tension. During major conflicts, U.S. markets may initially fall as investors react to uncertainty. However, the United States also benefits from its position as the world's reserve currency issuer. The U.S. dollar plays a central role in global trade and finance. Many commodities, including oil, are priced in dollars. This creates constant global demand for the currency. During crises, investors often purchase U.S. dollars because they trust the depth and liquidity of American financial markets. The United States also hosts some of the world's largest technology and defense companies. These sectors may experience increased government spending during geopolitical tension. As a result, certain parts of the U.S. economy may remain resilient even during global instability. Part 6. Dubai and the Middle East. Dubai plays a very different role in global finance. Unlike the United States, Dubai is not a superpower. Instead, it has positioned itself as a regional financial hub connecting Europe, Asia, and Africa. Dubai's economy is closely linked to global energy markets. Many Middle Eastern economies depend heavily on oil exports. When oil prices rise during geopolitical conflict, energy-producing countries may experience increased revenue. This can boost liquidity in regional financial systems. Dubai has also become a major destination for international wealth. Its financial districts host global banks, investment funds, and private wealth managers. When instability occurs in other parts of the world, some investors move assets into Dubai's financial ecosystem. However, proximity to geopolitical conflict can also create risk. If regional tensions escalate dramatically, investors may become cautious about exposure to Middle Eastern markets. This creates a complex balance between opportunity and risk. Part 7. Singapore as a financial safe haven. Now let's look at Singapore. Singapore is one of the world's most important financial centers. It serves as a gateway between Western capital and Asian markets. The country has built a reputation for political stability, strong financial regulation, and efficient legal systems. Because of this reputation, Singapore often attracts capital during periods of global uncertainty. Wealth managers, investment funds, and multinational corporations frequently use Singapore as a base for operations in Asia. When geopolitical tensions rise, investors sometimes increase allocations to Singapore-based financial institutions. Singapore's strategic location also allows it to serve as a major trade hub. However, the country remains heavily dependent on global trade. This means that major disruptions in global supply chains can still affect its economy. Even so, Singapore's stability often makes it attractive for investors seeking a secure financial environment in Asia. Part 8. The role of cryptocurrency in modern conflict. Now let's discuss a newer asset class, cryptocurrency. Bitcoin and other digital assets did not exist during most historical wars. This means their role during geopolitical crises is still evolving. Some investors believe cryptocurrencies function as digital safe haven assets. Because they operate on decentralized networks, they are not controlled by any single government. This creates the possibility that crypto could act as a form of financial protection during certain crises. However, cryptocurrencies also behave like high-risk assets. During periods of market panic, they sometimes fall alongside technology stocks and other speculative investments. This means their role during wartime remains uncertain. Cryptocurrency markets are still relatively young compared with traditional financial systems. Future geopolitical crises may reveal whether digital assets truly behave like safe havens or simply remain volatile investments. Conclusion: the real lesson for investors. So what happens to investments when war begins? The answer is complicated. Financial markets react quickly to geopolitical shocks. Energy prices often rise. Safe haven assets gain popularity. Certain industries benefit from increased government spending, and global capital moves towards stable financial centers. But history also shows that markets adapt. Investors eventually adjust to new geopolitical realities. Supply chains reorganize, governments respond with policy changes, and markets begin identifying new opportunities. War reshapes the global financial landscape, but it does not stop financial markets from functioning. In many cases, it simply redirects where money flows. Understanding these patterns allows investors to make more informed decisions during uncertain times. Because in the world of finance, the smartest investors do not simply react to crises. They study how money moves during them. I'm Professor Vortex, and if you want to understand how global events shape the future of wealth, make sure you subscribe for more deep dives into finance, geopolitics, and the hidden forces moving global markets. Until next time, stay curious and stay invested.